Let's welcome in our Alpha Manager of the day. Trideep Bhattacharya is joining in. He's Chief Investment Officer, Equities at Edelweiss Mutual Fund. Trideep, great to have you with us here. Thank you very much for your time. So is the market outlook a bit muddy without, no clear answers, right? Lots of questions, but very few answers. I guess one can say that is always the case, but can you confidently talk about how things will be 2 quarters down the line in terms of earnings?
Yeah, I think overall, 2 quarters down the line, or maybe 3 or 4 quarters down the line, the situation would be clearer with regards to from an earnings standpoint. But I think from where we are, this sort of a volatility, to be honest, last time when we came around, we talked about that overall, the first half of 2022 is expected to be fairly volatile. And we talked about, I recall, the next year to be a more on net balance, more volatile year, but the first half to be particularly that way, given there is a regime change which was about to happen, which is now, I think the market has digested. The geopolitical crisis, which has kind of flared up since then. And at that time, it was more Omicron issue, so to speak, last time that we spoke. And third is the stickiness of inflation. So all of these will find its way one way or another by the time we reach, if you ask me, somewhere around June, July, August, that kind of a time frame. So till that time, we always expected the market to be volatile. It's proving to be that way. But come the back half of the year, that's when I think some of the earnings recovery themes actually start to come through, which at the moment, I agree with you, appears a little muddy. But I think overall, if you look beyond this beyond the geopolitical crisis, it can't continue for years together. It for sure will be there to bother us for the next couple of months. And there will be implications of the economy. But we have come through a big crisis like COVID. We'll come through this one as well. So hence, as we get to the back half of FY23, I think the earnings resilience will start to show up. And my current thinking on markets, particularly over the next 2 to 3 years, will be constructive. And as we go through that, we'll have to go through a bit of uncertainty in the first half, which we are going through right now.
Okay, Trideep, hi, good afternoon. One thing which is clear is that inflation is hurting, right? Especially if you look at some of the consumption names. This month's top losers have been Maruti, Hindustan Unilever, Eicher Motors, and Britannia, all down 10%. And it's not as if these stocks were, in any case, having a big bull run, that this is a correction. These stocks, in any way, have been in a bit of a downtrend. So, are you considering this as a buying opportunity, or you think the threat of derating even from these levels is high?
I think in the near term, the stocks could, I can't comment on individual stocks, but we've been underweight consumer staples for a bit of time, for the last 3 to 6 months, which is factual information. So hence, in that context, the view that is kind of the stock, the way they have reacted is actually kind of in sync with what we have been, how our portfolios have been positioned. Going forward, I think some of these probably will kind of remain at these levels for the next 3 to 6 months is the way I think about it. And somewhere around those times would be good opportunities sort of to get in some of these names overall. But for the moment, we've been underweight consumer staples and utilities, and we're probably going to remain this way for the very short term, so to speak.
Trideep, you'll be feeling good towards the end of this financial year, because I think you had ITC in your large cap fund. And suddenly that one has come to life in the final month of this fiscal year, and that's moved higher as well, I think to close around 2.5% in terms of a weightage out there. But you said consumer staples is something that you'll be a little bit cautious on. And when we spoke, I think somewhere in the middle of February, you had said consumer staples you'll be skittish on, and also on the new age companies. Now, the new age companies, from there itself, they've corrected, some of them 25 to 35% they've corrected. Continue to remain skittish on them, or do you believe at some point of time, some of these new listings, new age companies, they'll start delivering some bit of value, or start offering some value? Your take?
So the reason why we have sort of stayed away from some of the new age companies has been that, on the back of supernormal earnings, which they have seen when they were, when we all were in lockdown, and then supernormal multiples, the stocks came for IPO. And since then, obviously, the lockdown has gone out, people have started going out, and hence more normalized earnings is what we would see in the next year or so. And hopefully, as you talked about the correction, more normalized multiples. And as the multiples normalize more and more, we are definitely evaluating some of these. But if you were to ask me today as we speak and take a rain check as where we are, I would say that we are still fairly cautious on some of these names. Not, I think the valuation comfort is incrementally getting better, but I would like to see more normalized earnings from some of these new age companies before we jump in. And clearly, some of these would be kind of 200, 300 baggers overall over the next 5, 10, 15 years. And if that be the case, the first maybe 10, 15%, even if we miss in this context, we are fine with that. But we'd rather be sure that the earnings that we are betting on are something that we can take to home.
Trideep, any thoughts on MCX, the commodity exchange, and how you would think about a business like that? There is great excitement about stock exchanges. We've got BSE listed, NSE, of course. There's been a clamor to buy the unlisted shares. What about a commodity exchange, in your opinion? What are prospects looking like?
I think, again, we can't talk specifically about stocks, but I would say that exchanges, particularly, depending on how dominant franchise they are in that in the asset class that they deal with, could be good proxies to play on the expanding markets over a period of time in India. And I think some of the exchanges we have sort of held through in our portfolios to our benefit over the past, and we think they also kind of help us during the volatile times to tide through because overall the trading volumes tend to increase. Also, I think as HNI, retail, and the investing population in India increases, the prospect of trading and more volume through the organized exchanges, the prominent ones, increase significantly. So depending on which exchange we are talking about, again, without getting very specific, but we would have some of these stocks in our portfolios overall, and we benefited from that, and we continue to hold the same.
Okay, all right. Trideep, you've been positive on some of these banking names. There have been a lot of selling, though, coming from the FIs, and the index itself is still close to around 18 to 20% away from the recent peak. Would you be looking to buy just the private sector names, the large private sector names, or would you go across the PSUs as well? Because some of them are offering value, but they've always been valuation attractive.
Yeah, I think it's a great question. I would say that our view on financials has been positive, but overall with a couple of nuances. More towards lending financials rather than the overall basket. So whether you look at NBFCs and some of the other aspects or some of the other segments within financials. So yes, some of these stocks have corrected because they were owned from an FII standpoint, and maybe kind of there are other compulsions more than fundamentals which is driving them lower. But I think if I were to look at the economy, the way we are looking to play, that we think that over the next 2 to 3 years we could see an economic cycle coming through, a capex cycle coming through. I think one of the strong legs of that would be a rebound in credit growth. And I think over the next 2 to 3 years, you would see, good examples of that coming through, so to speak. And hence, the lending financials is something that we are positive on, particularly corporate lenders. We have taken advantage historically of volatility like these to kind of increase our position in that. Of course, the stocks have corrected given some macro volatility, but I think that doesn't deter from our stance that we are believers in the medium-term corporate capex cycle that will come through. We also think that private sector investment demand is an area that one could sort of hang on hat on over the medium term, and both of these, the early way to play this through would be the financials. And hence, the relevant financials are something that we are positive on, not across the board, but more specifically the ones that are play on the capex cycle and whatnot. So yes, a bit of nuanced view on financials, but we have been positive on financials and we continue to remain the same and take advantage of this weakness to increase our positions in that.
Okay, all right. Thanks so much, Trideep, for stopping by and filling us in with your views on the markets as well as on a couple of those sectors that we just discussed. Looking forward to chatting up with you in the coming months. By the way, from the broader markets, TNPL, our ticker team is pulling